Good morning, Kyle. Good morning, everyone.
Morning, Dennis. How are you?
Very good, very good.
Yeah.
Lynette, how are you?
Good morning, everyone. I'm good too. Thank you.
Yeah, Taylor just asked us to wait a few minutes and start at about 10:35. All right, it's 10:35. Good afternoon, everyone. I want to take the time to thank everybody for joining us today. I was asked to speak about insurance for corporations. And I know that for the last probably year, at least 6 months, we've been spending a lot of time talking about IAPAR. I think it's probably become one of the most popular products. And I know that for the most part, a lot of brokers just jump to IAPAR as a solution for their corporate clients. What I want to do today is talk about how there are other options. And IAPAR is a good option, but not always the best option. And like anything else we do with our clients, it's always important to do the needs analysis, understand what their ultimate goals are, and sometimes that'll help us understand that, they don't need to spend all the extra premium on what PAR plans cost.
It takes the guesswork out of rate reductions,
I can
leading
get someone to just put themselves on mute if you guys are on another webinar.
and on equity takeouts. With this new
All right, thank you. I guess it's a good way to get double CE credits, have two webinars running at the same time. But anyways, all right, so back to what we're going to talk about. So we're going to focus on corporate insurance, some solutions, some ideas, and then show you that you can kind of fit those needs with different options. It's not always the same product sold the same way. And as always, if there's questions along the way, feel free to ask. Dennis is on the call. I'll ask him to monitor the chat. And he can try and answer the questions that come up. If not, we can just take a quick break and I can try and answer the questions as we go through. So I wanted to start off with just sharing with you guys some successes that IA has had. And a lot of this is attributed to the brokers like yourselves that support IA and help us achieve what we achieve. At the end of 2022, we were at over 4 million clients nationally. We have over 8,200 employees nationally, over 50,000 brokers in Canada write IA or sell IA policies. When we look at our assets under management, we're just over 220 billion. And then the market cap number, I don't know if that makes a difference to anybody, but we're very well capitalized. And for those of you that have been with IA or writing IA for a long time, and were fortunate enough to purchase IA stock when we first went public back in 2000, you would have seen a really good return over the last 23 years. Our stock value is up 700% since inception in the year 2000. So, some of you were lucky enough to get on board back then, and you probably benefited from some of that. The other thing I wanted to go is just a quick summary of how IA ended the year 2022. At the very top, you can see IA was number one in advisor perception. What that means is there's a third-party research company called Environics. And what Environics does is they survey licensed insurance brokers nationally and basically ask those brokers to rate different companies based on different things like the ease of use, their e-app, their wholesale team, their product lineup, things they like about companies, things they don't like about companies. And Environics then compiles all of the data and they come up with a ranking of life insurance companies in Canada. It's with great pride and something I is very excited about to share with you guys that both in 2021 and in 2022, I was number one in advisor perception in Canada. So that's thanks to the brokers that responded back to the survey, and with all of the feedback that was received, a lot of the highlights or the reasons why IA was number one were around one, our product lineup and having a complete product lineup, two, our software and how easy the e-app process is. Three was our compensation models. I think the bonusing that we have with CPB and BDB plays a big part in what advisors appreciate about IA, and the success that we've had on the savings side. We've been able to provide clients with really good returns, steady returns, for at least the last 7 to 8 years if you've been active with IA on the investment side. So, a couple of things that we wanted to share with you guys and say thank you guys for, choosing IA or making IA number one in advisor perception. Outside of that, we ended the year in 2022, number one in total policies sold in Canada, meaning IA sold more policies than any other insurance company in Canada. Not necessarily number one in premiums. Some of the other companies that'll remain nameless, usually we used to call them the big three. They write a lot more larger case policies than IA does, meaning, 2 million, 5 million in premium cases. And that really helps elevate them to the higher premium totals. But when it just comes to straight case count and the number of policies sold, IA was number one last year. IA was also number one in claims paid. IA was number one in term premium. And as you guys know, this has been running for probably about the last 3 years, IA, again, was number one in critical illness sales. For those that aren't aware, IA sells almost 50% of all critical illness in the Canadian marketplace. If you have not looked at IACI and you sell CI, you need to look at IACI. There's a reason why we sell more policies than anybody else. We sell 50% of what is sold in the market. Out of every 2 policies that Canadians buy for critical illness, 1 is always an IA policy. So like I said, if you sell CI and you don't look at IA or you haven't looked at IA, please look at IA. There's going to be some real value and benefits to you and your clients to do that. On the savings side, we were number one in net sales, which has kind of been consistent since 2016. But for the first time last year, not only were we number one in net sales on the savings side, we were also number one in gross sales, which means all of the success that we've seen since 2016 on the SegFund platform, we're starting to see even more of it as we escalate into what 2002 was, more volatile times. There's just a higher level of confidence with IA and what we do. So again, if you're on the savings side of the business with your clients and you haven't looked at IA, you need to look at IA. There's going to be some hidden value there to you and your clients by doing so. And then the last piece I want to talk about is, we were rated number one in advisor perception, and a lot of that was based on our electronic application. I think when the pandemic hit us in 2019, 2020, I was just in a really good spot with our electronic application, both on the life insurance side and the savings side. And I think that really propelled IA through the pandemic. We had really good results all the way through the pandemic. But I think it also allowed brokers to create that level of comfort with our eApp platform. And for those of you that do eApp on a regular basis, I challenge you to find another company's platform that you would say is much, much better than IA's. One of the things that everybody has is an eApp platform. One of the things IA has is not only an eApp platform, but Evo is a rate engine. Evo will allow your client's information to be scored and rated as you complete the application. And as many of you know that have written IA and used Evo, when you submit that application through to Evo electronically, there is a chance that you can get an instant approval at point of sale. What does that mean? That means after you've completed the application, if there are no medical requirements, so basically clients up to the age of 50, up to $2 million of face amount, there is a chance that Evo will instantly approve your client. That means it doesn't have to go to an underwriter. It doesn't have to be reviewed by anybody. And the policy basically gets issued in 2 days. So not only does a client get their policy quicker, you get paid quicker. So something that's really propelled our success over the last 3 years or 4 years, and it continues to really drive why brokers choose to use IA. And on the PAR side, the reason we've been talking about PAR so much, we've only had our PAR product since 2022, 2021 is when we launched our original version of PAR. And then last year, we launched our wealth version of PAR. And in the short time that we've had the PAR policy or the PAR product, we've gone from being nowhere ranked out of all the companies that sell PAR in Canada to being number 3 in PAR sales. We've had in the last 2 years, over 5,000 advisors sell at least one IA PAR policy. Over 23,000 clients have purchased an IA PAR policy. And our minimum premium since launch is over $100 million now. So not looking at ADO, just looking at base plans and total in force, we're over $100 million already. We saw on the PAR side over 300% growth in 2022. And again, thank you to everybody out there for contributing to this. If you're one of those 5,000 advisors that sold an IA policy or an IA PAR policy, we do thank you for that. And for those of you that do sell PAR in the marketplace and haven't looked at IA, again, I urge you, take a look at IA. There's going to be some hidden value to both you and your clients because we do have a great product. And I think just the growth that we've seen in a short period of time, in under 2 years, kind of validates the quality and the value of our IA PAR product. Before I get right into the case study, the last thing I wanted to talk about was when we launched our IA PAR product, our dividend was set at 5.75. And as of January of 2023, January of this year, we declared an increase to our dividend, and our current dividend is now 6%. So again, something to reflect all the success that we've seen, in a time where other PAR companies are keeping their dividends flat. Some have even reduced dividends. IA has managed to increase by 0.25%, and we've gone from 5.75 to 6. All right, so participating life insurance as a liquid asset for a corporation. So when we look at corporations, we need to understand why is it that they would look for insurance or why would they want insurance? And there could be a lot of reasons. But I think this also helps us in focusing when we speak to corporate clients about the reasons why they may haven't thought about life insurance, but there could be this need and they haven't thought about it yet. The first and the most common is going to be that pay taxes on death. That's why most people will do estate type planning, sell life insurance or buy life insurance, because they want to be able to save as much of their assets at death and not have to liquidate assets to pay taxes. And hopefully their life insurance plan is available to pay their taxes for them. Another common reason for life insurance when it comes to corporations is shareholder agreements, or what we like to call buy-sell agreements. When there's multiple partners, sometimes we need to make sure that the partners are protected, that there's an exit strategy. What happens if one of the partners passes away? Without buy-sell agreements or without these shareholder agreements, you might end up having a new shareholder that you don't want to be partners with. An example, If I were to pass away and my wife were to inherit my shares, if there was no mechanism for the corporation or my remaining partners to buy my spouse's shares or my wife's shares, then my wife would have every right to come in and start operating the business with them. And maybe that's not what they want. So, buy sell agreements, shareholder agreements are really important talking points. I can tell you that many, many, many corporations that have more than one shareholder don't have shareholder agreements in place. And it becomes one of those things. It's a talking point where, it's advice that we provide. Now, I'll put it to you this way. We do not, as advisors or as an insurance company, help with the shareholder agreement or crafting the buy-sell agreement. That has to be done with lawyers. That has to be done with accountants that come up with values. What insurance companies do and what you as an advisor do when it comes to shareholder agreements or buy-sell agreements is we provide the mechanism to fund the agreement. We don't craft the agreement. We don't make it up with the client. We don't counsel on what should be included and not included in the buy-sell agreement. That all comes from a lawyer. What we do is once they have the agreement in place, there is money required to make sure the agreement can get funded. And that's where we as advisors and the insurance company come into play. Sometimes we just want to create additional wealth. There's cash flow in the corporation. They're looking to invest some money, whether they decide to invest in the markets or invest in real estate within the corporation. Sometimes there's an option of looking at investing in life insurance policies, especially high growth policies like PAR that can provide some really good returns with some decent security. We've also heard of key person insurance. Sometimes there's a corporation and their revenues and their success is so tied to one or two key individuals that we want to make sure that those individuals' lives are protected. So if something were to happen to them, there's some compensation back to the corporation. And we can look at key person insurance. Sometimes we want to finance share redemptions. This goes back to that shareholder agreement. There might be something in the agreement that talks about retirement and what happens when one of the partners wants to retire. What's the obligation of the other partners as far as purchasing those shares? Because maybe in retirement, the shareholder doesn't want to keep their shares. They want to fully step away and retire. And there has to be a mechanism in place to be able to fund that. Well, there's a lot of options we have. And one is any life insurance policy with strong cash values, because the corporation can always use those cash values, leverage out some money, and use that money to buy out the shareholder that wants to retire. But again, something else that we can do. And like I said, it has nothing to do with us building the shareholder agreement. It's we come up with solutions on how to fund the shareholder agreement. The other is, and it's becoming a little bit more popular, I'm seeing a lot more of these today, is protection of a corporate loans. So corporations that are looking to expand sometimes have to go to the bank and get a loan. And a lot of times corporations don't necessarily have collateral. What they have is a reputation, good cash flow, and a great business model. And sometimes banks will sit down with those corporations and extend them an unsecured loan. But at some point, they need some sort of security. And what we're starting to find now is that banks are asking for corporations to make sure that certain things are in place, like life insurance, so that if the shareholder were to pass away or the shareholders, there would be a mechanism for the bank loans to get paid out. And that would just provide some security. Again, those could be key individuals that the bank wants the insurance on. It could be the shareholders. But a lot of times now we're starting to see where banks are asking corporations to buy insurance to make sure that if death occurs to some key individuals, that the loans can still be paid. And the last thing is really it's about tax efficiency. It kind of goes back to paying that tax on death. It's really a way of creating some tax efficiency for corporations. And life insurance is probably the best way to do that because you can pay taxes on with pennies on the dollar simply by what you purchase and the product you go with. But really, at the end of the day, the main concern is what happens at death. Death triggers so many things inside a corporation, and there could be some huge costs associated with that. So really, when it comes to corporate insurance and setting something up, their real concern is what happens when death occurs. So as you know, I like going through case studies. So we're going to go with a case study here. We have David. He's a non-smoker and he's 50 years old. He's an entrepreneur, sole shareholder of a holding corporation, and the holdco owns shares in an operating company that we're going to call OpCo. The fair market value of the business is $3 million. And based on a consultation that David had with his accountant and his business managers at his business, they expect to see the business grow at about 5% per year. Okay. So there's a couple of things that we have to worry about here. One, David's still relatively young. He's 50 years old. He has his corporation with market value of 3 million. And he knows that he's going to have some tax liability issues. He wants to make sure he can maximize the value of the estate he's creating for his family. And we got to make sure that we can try and keep up or at least identify the fact that the business is growing at 5%. So maybe in 15 years, when he's closer to retirement at 65, or 20 years if he chooses to work till 70, we have a sense of what the value of the business is going to be around that time so that we can start to make sure that we have the right mechanisms in place to provide the coverage that's going to be needed for the corporation. So right off the bat, some of David's challenges, well, during his active business operation. So while he's still working actively in the business, he wants to make sure that he's protecting the business value moving forward. Transfer of wealth, the estate. We might even consider David a key individual. So there might be the need to be able to provide some sort of key individual coverage. If something were to happen to him, the corporation might need to replace him. That's going to come at a cost. So there's a lot of considerations that we have. He also wants to make sure that he reduces the tax burden on the business as we move forward. And a lot of this has to do with investments, tax returns, and passive income. For those of you that are in the commercial insurance space or corporate insurance space, you understand that when corporations are taxed, different types of investments, different types of revenue are taxed at different rates. And passive income is something that is taxed at a lower rate until you hit a threshold. And then all of a sudden, anything in excess gets taxed at a higher rate. So a lot of times we want to try and create mechanisms that reduces what we call passive income. And I don't want to get into too many details on the corporate side, but if any of you have questions around that, feel free to connect with either Dennis or myself after the session. And then the third thing that David's concerned about or has a challenge with is he wants to make sure that he maintains liquidity in his business. Because with David, he's constantly reinvesting money into his business. So just because he has good cash flow and good retained earnings doesn't mean he wants to put it all into a life insurance policy. Okay. He might want some of it to be kept elsewhere because he's constantly reinvesting to grow his business. After the sale of the business or after death, so some of his concerns are how does he maintain some liquidity to pay whatever taxes need to be paid or whatever charges or costs that need to be paid. He wants to be able to cover those taxes on death, and he wants some estate planning. He wants to make sure that there's some sort of succession of either getting the assets out of the corporation in a tax efficient manner and into the hands of his family if his family decide they don't want to take over the corporation. So before I move forward, are there any questions? Let me just see if there's anything in the chat. I don't see anything in the chat.
I don't see anything in chat either.
Okay.
I'm monitoring it, but I don't know if I'll be able to see anyone's questions because I think I'm just a participant, but I'm paying attention.
Okay, no problem. No problem. So if there are questions, like I said, put them in the chat. So we've gone through the case study. We have an entrepreneur. He has a couple of concerns and challenges while he's working and in retirement, and we're going to look at some possible solutions for him. So the first thing is, let's take a look at the value of his business and what we can expect that growth to look like. So again, we know we're growing at 5%, which is what we've projected this out at. At age 50, as current, his business is worth $3 million. By the time he's 65, it's going to be worth about $6 million. By the time he's 85, around life expectancy, it's going to be shy of just $9 billion in value. So we know that the higher the fair market value of your business is, the higher the taxes will be that CRA is going to assess. So we need to make sure that we're providing some sort of tax protection. okay, along the way, so that what we're proposing does make sense. Taxes on death. So just a quick overview. When death occurs, shares are considered deemed dispositions, meaning if a share is worth $1 million, it's considered a liquid million that you've cashed out, and now you need to pay taxes on it. While you're holding it in share value inside the corporation, maybe you're not paying tax on it as it grows. It's until you sell it, which is considered the disposition, and on death, your shares are considered not disposed of, but the action of disposition is taking place. We have to understand capital gains and how they reflect on that deemed disposition or the deemed proceeds of the disposition. It's always a fair calculation, and we know this, we've heard it. It's fair market value less the adjusted cost base. So obviously, the older the client is, the longer they've had their policy, that adjusted cost base starts to whittle down. So we have to be very careful, because whether if the shareholder passes away earlier versus later, the actual tax impact or percentage of growth or commercial value or corporate value will change along the way. And you know that we understand that capital gains are 50% taxable, whether it's in the corporation or not inside the corporation. Taxable gains are always 50% taxable. Capital gains exemptions, sometimes that exists, and sometimes we can maximize values there. Maybe there's a spousal tax-free rollover that's available. We can look at that. Again, we would engage an accountant to discuss those things. And sometimes there's a double taxation problem, where not only are they paying tax on the corporation along the way, but when the shares are deemed disposed, there's a tax bill. And then when they end up in the hands of a family member, there could be another tax bill. So there's scenarios where sometimes you'll see double taxation happening. And a lot of this stuff we can discuss with the clients ahead of time, and at least make sure they have the answers from their accountants and their lawyers. For those of you that aren't familiar, at IA, we actually have an advanced case and tax planning team at head office, where we have tax lawyers and some accountants on board that can provide some guidance and even arrange to meet with the clients, lawyers, and accountants to bridge that gap if need be. Okay, so we'll never, as IA, as a wholesaler, Dennis and I will never say we'll provide you that tax advice, because I'm not qualified to. But we do have people at head office that can provide some guidance and some advice based on the client situation. So we do know, because we saw 2 slides ago, that the corporation fair market value is growing over time. It's growing at 5% per year. And we also understand that as the corporation value grows, so does the tax bill. So it shouldn't be any surprise that we're going to have a growing tax bill, which means really our need is a growing need. It's not a static need. And when we think about it, when we look at our fair market value of a business, that does not mean that's what my family is going to get. So at age 65, when my business is worth 6 million, or at age 85, when it's worth almost 9 million, that doesn't mean my family is going to get $9 million worth of value. What it means is that's the fair market value. CRA always has to take their cut. And the family is going to be basically eligible for a smaller amount than the fair market value of the corporation. What you and I are talking about here is, how do we bridge this gap? How do we cover this gap so that David can leave a $9 million asset to his family at age 85? So we're going to look at 3 different solutions for David. Okay, I'm going to look at a straightforward, easy solution, a term 100. And then we're going to look at IA par and look at the differences between what the term 100 gives us and what the IA par gives us, both the goods and the bads. We're going to then look at IA par and a strategy to leverage money out of that plan right away. And for those of you that are familiar with leveraging strategies, specifically what I'm going to look and compare to is something called an immediate financing agreement, or immediate financing arrangement, or what we like to call an IFA. All right, and then I'll compare the 3 and show you the pros and cons of all 3, because there's value to all 3, There's really good things about all three. There's really bad things about all three. And we just have to understand all of them well enough so that we can articulate and share that with clients so that ultimately they can make the best decision based on the information we provided. So to start off with, we're going to do T100, option one. Straightforward. We have $3 million value in the corporation. We know the tax bill today is not going to be 1.5 million or half of it. We know it's going to be much less than that. But we also know that T100s don't grow. So what I'm buying as far as coverage is going to have to provide enough tax protection for the next little while, next bit of the future. So when I look at it, the T100 for David, non-smoker, 50-year-old male, is about $20,500 annual premium. Sounds like a lot, but technically when you think about it, you're getting 1.5 million in coverage at age 50. So really a good way of doing it. So some of the key takeaways. One, it's really simple and affordable. It's T100. Nothing to explain. There's no cash values. You buy, you pay, you get. As long as you continue paying, you're going to get your death benefit. Straightforward. There's nothing else. There's no bells and whistles. And it's very predictable. I know that for the rest of his life, it's going to be $20,500 a year to pay for the policy. And he pays it as long as he wants to keep the coverage there. What are some of the downsides, though? Well, I'm only buying $1.5 million worth of coverage. So if the blue line is my tax bill, up until age 65, I probably have more than I need to cover the tax bill, or at least enough to cover the tax bill. But after a certain point in time, my tax bill continues to grow and this stays flat. So it's a plan that doesn't necessarily allow me to cover the full taxes all the time. But it's still a good solution because at the end of the day, it's buying the family back $1.5 million of tax breathing space, right? So it's enhancing the estate by $1.5 million. Whatever the end result is, it's an enhancement to the estate at $1.5 million. You might get to a point where it's not covering the full $3 million tax bill, but at least half of it is being paid. And half is better than nothing. So still a good solution, very easy, straightforward. A lot of corporations go this way just because it makes sense for them from a cash flow perspective. Option two, we're going to look at IA PAR. And we're going to look at the wealth version of PAR because of David's age and the fact that we want to start leveraging money out right away. Okay, so as we said, David does have cash flow, but he doesn't want to tie up all of his resources. So he needs something that's going to give him some flexibility. So IA PAR, we're going to look at the same 1.5 million of initial death benefit. When we look at it, the 100,000, we're going to ask David for a $100,000 deposit over a 10-year period. And then we're going to do an offset in year 11, meaning we're going to create a 10-pay for him. $100,000 a year is what we're going to ask for. Out of that, the base premium for 1.5 million is $38,350. And he commits to that for 10 years. And we're also going to be maxing out his ADO or additional deposit options at $61,650 for 10 years. And together he's paying $100,000. So right off the bat, we know that just base premium, he's already double what he was going to be paying on the T100. So right off the bat, there's more cash requirements here. There's more cash flow requirements and a bigger commitment. The reason we're maxing out ADO is so that I can create a 10-pay. I want to be able to max out the ADO so that I can create an offset possibility as early as possible. And really at this point, I can even create it earlier than 10 years, but we're doing it 10 years to optimize it because we figure he's 50, he commits to this plan until he's 60, and the plan is fully paid, but he has a protected asset inside his corporation. So now when I look at it, if I look at the insurance need versus the insurance coverage, so I know the blue line is my potential tax requirements. When I look at term 100, we know that we buy 1.5 million, we pay our 20,500 a year, and we get 1.5 million in coverage. And we talked about how in the earlier years, I'm getting more coverage than I actually need. And in the later years, it's less. But ultimately, it's still a good solution because at least 1.5 million of my tax bills being paid, if not. So I have good coverage. I've enhanced my estate by 1.5 million, and it's a good solution. Then we run to option 2, which is IA par. And as you can see, when we look at IA par, it's a little bit more intense as far as what we're getting coverage on. So my death benefit is going to grow over the 10 years that I'm paying, and then it kind of slows the growth a little bit, and then it takes off again. But as you can see, my IA par is always much higher than what my projected tax bill is going to be. So I know for sure this par option is going to cover my tax bills and then some. Not only will it pay the taxes, it's also going to further enhance my estate. So again, I've achieved a couple of different goals that David had, because he also wanted to make sure that he maximizes estate value as well as cover taxes. So we've done both here, but it's at a bigger requirement. It's at 100,000 a year versus 20,000 a year for the term 100. If I look at net estate values and I compare the difference between the term 100 and the IA par, now this chart is a little bit confusing because term 100, you would expect it to be flat across. But understand, this is net estate value. This is death benefit minus the taxes. So what is my net estate benefit? And obviously earlier on, my net estate benefit is higher versus the IA par. But you can see that IA par along the way is always better than the term 100. I'm always going to do better with the IA par on that net estate enhancement, whatever you want to call it. So it is a good solution if that's one of the priorities and one of the goals. But again, it comes at a higher cost. It's 100,000 of premium to achieve the green line versus 20,000 of premium to achieve the red line. So some key takeaways. Well, we have the option of that limited payment period with the offset feature. So that's a plus. ADO allows that flexibility too. Because like I said, we're going to commit the client to 100,000 a year based on the plan that we have. But what happens if in 2 years the economy takes a turn and the business is struggling a little bit? Maybe the client doesn't have the full 100,000 that year to pay. Well, if I go back down a few slides, the minimum the client has to pay to keep this plan going is 38,000. We're forcing the extra 61,000 to get it up to 100 just so that it gives us a fund, a little safety net so that we can stop paying in year 10. But it also gives me flexibility because in a year that I don't want to pay the 100,000, as long as I pay the 38, I can keep the plan going. And instead of offsetting in year 10 or offsetting in year 11, maybe I offset it in year 12 or year 13. So it allows me some flexibility and still allows me to achieve similar goals that I had in plan. The cash surrender values on anything par is considered a liquid asset. We can, one, surrender the policy if that's an option. Usually not recommended, but that's an option. We can also use the cash surrender values on a par plan as collateral and go to a bank and get a collateral loan. And that loan allows me access to some funds. So I have liquid assets available through the plan. The downside is the cash flow. And we talked about that. It's $100,000 over 10 years. So it is intensive. And maybe David likes the idea, maybe David doesn't like the idea. But over 10 years, it's 100,000 a year or a total of $1 million invested. And then we're going to look at the third option. And the third option here is the same as the second option with another layer on it. So like the second option, we're going to do a $1.5 million IA par wealth. We're going to do 100,000 a year in payments for 10 years with an offset in year 11. And that means our premium is $38,350 for the first 10 years. That's base premium. And we're asking for additional deposits of an extra $61,600 per year for 10 years. So the 38 plus the 61 is 100,000 commitment every year. But what we're going to do here is we're going to do something a little bit different, and we're going to leverage the money back. Because David said to us that he doesn't want to tie up his cash flow, but he likes the idea that he can stop paying in 10 years. He likes the idea that his estate is being maximized. He likes the idea the plan is growing and is going to always more than cover his tax bill. So he likes all those things, but he doesn't like the fact that he needs to tie up $100,000 of his revenue inside his corporation, because normally he would take that to reinvest it to grow the value of his corporation. And by layering this leveraging strategy, we allow him to buy the life insurance policy that he's looking for. And we allow him to get access to his cash right away because of the liquidity, and allow him the opportunity to reinvest it in his business right away. So a couple of things we're going to look at on the leveraging side. We're going to look at a loan interest rate of 5.5%. We're going to look at corporate borrowing on this money. And we want to be able to leverage back 100% of the premium. So if David's putting in 100,000, we're going to ask the bank for 100,000 back every year for every year that I pay premium. So over a 10-year period, my loan's going to grow to $1 million. Okay. And it does say without refinancing. So what that means is David has agreed that after he gets his 100,000 back, David will pay the interest every year. Now, the reason it makes sense for David to pay the interest every year is, one, David is taking that money from the loan and he's reinvesting it in his business. Any loan money that you get that you reinvest, you get the ability to write off the interest as a tax deduction. So the interest that's going to be charged on his outstanding loan, because David is paying it every year, it now becomes a tax deduction for David. So there's some internal intrinsic value in doing that. So really the leveraging strategy, who is it for? Like, which one of your clients do you approach about this? Because it's not for everyone. And if you look at the left side here, we talk about affluent clients, and I think everybody has a different definition of an affluent client. But really, when it boils down to it, the types of clients that actually go along with these types of leveraging strategies, what we call an IFA, they tend to be clients that are a little bit more sophisticated and financially aware. So they understand markets, they understand lending, they understand leveraging, they understand all of these things, not just at a basic level, okay? They have to be comfortable with the idea of leveraging and carrying debt. Not everybody is. They have to be comfortable. If you think about the strategy, when David is 65, even when David is 60, David will have, in this strategy, $1 million outstanding loan against his life insurance policy. That $1 million outstanding loan is debt. And David's going to get an annual statement from the bank reminding him that he owes them $1 million. The client has to be comfortable with that. If that's going to stress out your client, the IFA is probably not for them. If that's going to make your client lose sleep over it, because of it, it's not for your client. So we have to find clients that are comfortable with the idea of leveraging and the idea of carrying debt, because carrying debt's not always a bad thing, especially if that interest for the debt is a tax break for me. If I can benefit from it, it's always advantageous. But I have to be able to sleep at night and be comfortable with carrying that debt. Okay. And you have to understand that when you're doing these types of things, there is going to be a minimum policy size that's required, or a minimum amount of leveraging that has to take place. Most banks will not use your life insurance policy in an IFA type strategy unless you are taking out at least $50,000 a year in leverage. So if my policy doesn't allow for that, or if my premium on my plan is $20,000 or $10,000 a year, the IFA strategy doesn't even make sense. They need to be larger policies with larger premium amounts. So really, concisely, the concept is this. I have my holdco. I buy a life insurance policy and I pay for it for the 10 years. My life insurance policy comes with cash surrender value from day one. I take that cash surrender value and I assign it to a bank or a lender, and they give me a money or a loan in its place. So I put in $100,000. I have cash surrender value. I have an agreement with the bank, and they're going to give me back $100,000. Maybe they're asking for outside collateral. Maybe they're asking for something on the side, but they're going to give me back my $100,000. I take that $100,000 and I reinvest it into my holdco. I get my tax break on the interest that I pay, and then the next year I do the exact same thing. I pay my premium $100,000. I go to the bank gives me back $100,000. I reinvest it in my business, write off the taxes. Do it again for the third year. Do it for 10 years in a row. And then after that, I'm not going back to the bank borrowing more money. I've already borrowed 10 years worth, so a total of $1 million. I have an outstanding loan for $1 million. And the only thing I do is every year I pay the interest on that loan, and that interest is now a tax deduction for me and my corporation. And I continue to do that, cycle it until we get through. A question for anybody out there. Can anybody tell me what is the best way to get out of this type of IFA scenario or an immediate financing strategy? Can anybody take a guess on what the best way is? Anyone? Nobody wants to take a guess? All right. So the cleanest way, and really the way that it's designed to work, is death has to occur. Because what happens is at death, the life insurance policy gets paid to the corporation. The corporation takes money out of the death benefit that was paid, and they pay off the outstanding loan, $1 million. And now the corporation is left with the difference. And that difference should be enough, if we did it right, to cover the tax bill and then some. And the corporation over the years has benefited from the fact that they've been getting a tax deduction on all of the interest they've been paying. Okay. And we also expect that the life insurance policy, because it is par, has grown so that after paying the $1 million loan, I still have enough to cover the taxes and cover some extra. So a couple of things that I need to make sure that everybody understands clearly. So leveraging strategy, two separate concepts here, right? Or there's two separate components, sorry. There's the life insurance component, which is what we do. That's what you talk to your client about. That's what IA provides for the solution. The second part is the collateral loan. And that's always with an external lender. It's not with IA. IA is not responsible for making sure the client gets approved for an IFA loan. That has nothing to do with the insurance company. That has everything to do with you and the client and whichever lender you guys decide to pick. Now, you can go to their existing bank if they feel they can get a better loan rate there. We do have some lending agreements in place, so we can tell you who to approach and who at those places to approach. We can give you names and an application to get you started, but ultimately it's between you and your client to make sure that the collateral loan piece with the external lender is taken care of. IA does not get involved in any way in that process. The only thing IA does is we provide the life insurance policy and we provide the guarantees of cash value that the lender is going to need for the collateral. Okay. So the loan, there's a couple of things that we need to keep in mind because every loan is going to be different depending on the lender, depending on the client, depending on what you want, what the client wants. Loans can have multiple conditions. So we're always using an external lender. A lot of times the lender is going to determine what's the max amount of loan they'll give you. So maybe I can't, for David, at lender A, get 100% of my premium back. So now I'm going to have to find another lender that'll give me 100%. Sometimes the interest rates are negotiated. So depending on the lender, again, I might be able to get a better interest rate with lender C versus lender B or lender A, but lender C might not give me all of the other conditions. So there's a lot of things that need to be figured out. That's why IA doesn't get involved in the process. There's also financial underwriting requirements to qualify for these loans. Every company's going to have their own requirements. Interest payments. Are we allowed to roll the interest back into the loan? Are they forcing me to pay the interest? That's something else that can be negotiated. That's available depending on the lender that you pick. And there's a lot more other options available. Will they force you to use outside collateral if you're leveraging more than the cash value of the policy? What other requirements do they have? Is there going to be a condition where they can't start the loan in year one, but they can start this leveraging in year two? Maybe that's one of the conditions that the bank will put in place. So we have to kind of go through and do our research to figure out what's going to be the best possible solution for the client at it all. And really, we need to understand how the ACB is going to impact anything that we do when it comes to surrendering the policy. And that's why I said, really the best way once you started an IFA scenario is death, because at death, all the proceeds are tax-free. If I'm still alive and I want to pay off my loan, one, I'm not eligible for the full death benefit. I'm eligible for the cash surrender value, which is a lower number. And I'm only eligible for that for that cash surrender value after ACB calculation. So if my cash surrender value is 1.4 million and I owe $1 million loan, I might be able to cash out my policy and surrender it. After tax, I might end up with $1 million or $1,050,000, and I'll have enough for the loan. But what happens if my loan is $1 million and my cash surrender value is $1 million? Well, if I surrender my policy to pay off the loan, as soon as you surrender the policy, that $1 million of cash surrender value gets adjusted based on ACB calculation. And the client or the corporation might only get $900,000 after taxes. Well, they get $900,000 from the surrender of the policy, but they owe the bank $1 million, which means now the corporation is out of pocket $100,000. It might not make sense to do. And that's why I go back to the client and the corporation has to be comfortable carrying that debt and keeping it long-term, because death is the best way, the cleanest way for them to maximize values. Interest deductibility requirements, like I said, there are different considerations. I'm not going to go into too much detail, but as long as the interest is being paid and the money from the loan has been reinvested and can be proven to be reinvested, there is the benefit of being able to write off the interest of the loan as a tax deduction. Keep in mind, though, it's important that there is this definite plan to reinvest. If David's plan was, I'm going to give you 100,000, I'm going to go to the bank, get 100,000 back, and then I'm going to go buy a yacht, or I'm going to go on a vacation with my family. Not the best use of an IFA. There has to be the understanding that they are going to take advantage of the tax deduction option that's available because they're reinvesting the money. There has to be a plan to reinvest. I can't stress that enough. I've seen too many brokers not have a plan for reinvestment with their client. And the IFA just doesn't make sense at that point. I need to be having some sort of tax benefit, tax breaks along the way. And if I'm not, it might not make sense to do this at all. So I like this one. This is cumulative cash flow, meaning what is the burden to the corporation as far as cash flow to pay for my plans? So the red line is straightforward. It's the T100. I know it's $20,000 a year. I know that every 10 years, it's going to be $200,000 to me, and that continues to grow. I pay $20,000 a year until I die. My only enemy here with the Term 100 is at some point, if I live too long, it's going to be costing me more than the par plans would have. Okay. So at some point, but that's past age 95, par might have actually cost me less and given me more. But we know life expectancy is much earlier than that. And the Term 100 from a cash flow perspective is less intense than a par. The green line is option 2, which is straight pay for the policy, no leveraging. So I pay $100,000 a year. I get up to $1 million in total after 10 years. And then I just ride it out and my loan stays at $1 million. And that's been the out-of-pocket cash flow for me. Okay. The black line is IA par with the IFA leveraging strategy. Because I'm leveraging money back every year, I pay my 100,000, I get some back. I pay my 100,000, I get some back. I pay my 100,000, get some back. The only thing that's costing me on this leveraging strategy is the interest payments every year. Obviously, those interest payments grow. So as you see over time, it'll end up costing me more than par with no leverage. But from a cash flow perspective, from protecting the corporation's ability to reinvest in itself with its current retained earnings, it mimics the same cash flow as a Term 100. Which means from a perspective of I have money, I need to grow my business, but I have this need and I want to buy life insurance, it allows me to buy protection similar to just a straight par plan. But it allows me to manage my cash flows better. Does that make sense? So basically I can buy a growing asset like a par plan, and I can do it with cash flows that are equal to that of a Term 100. But again, a lot of considerations with the IFA. It's not for everyone. When I look at net estate value, you'll notice that whichever way I look at it, whether it's the straight IA par option 2 or option 3, par with the leveraging, which is the black line, or the T100, which is the red line, I'm getting some net estate value benefit. So along the way, I'm getting some benefit. Whether I do the leveraging or I not, I'm getting similar benefit between par, which is much better than the Term 100. But again, remember, these come with higher costs, some extra risk, and some things the client might not like. But we still maintain high estate values. And whether you pick this or any of these two, there's still a benefit to the client. Just because these are better as far as net estate value goes, doesn't mean the Term 100 is not a good option. The Term 100 is still a really good option. We don't just discount it. It's part of the conversation and what we present to the client. So one thing I need to make sure and make clear, because I have brokers that do 100% premium financing, and they're able to find a financial institution or a lender that will let them take the interest and roll it back into the loan, which means from a cash flow perspective, there's zero requirements annually, because whatever they put in, they get back and they don't even pay the interest. Well, the problem with that is that loan, because of the interest, grows much quicker. And you may run into a risk in the future where the loan total is exceeding the growth on the life insurance policy. And when that happens, guess what? The bank is going to recall the loan. The bank doesn't like that. So to put all your eggs in one basket, not pay anything, which some brokers like to do because they tell their clients, I can get you free insurance. Give me 100,000, I'll give you 100,000 back. You don't have to pay the interest. We'll just roll it right into the loan. You don't have to worry about anything else. We'll just give you dollar for dollar, everything you put in, you get back, and you don't have to pay anything. Well, maybe it's possible to structure that way, but there are a lot of considerations like once that loan starts to grow, the bank might not like it. They might ask you to pay back the loan, which might force you to prematurely cash surrender your policy. And as we said in early examples, after adjusted cost base, what I get in hand in a cash surrender situation might not be enough to cover the full loan. I might be out of pocket more money. So it's not free insurance. At some point down the road, there is a cost that'll have to be paid. So do not represent it as free insurance because it's not. It's not zero cost insurance. And it's also not borrowing to pay premiums. I've had brokers ask me this too. So what you're saying is I can give you 100,000, you put it in the policy, and then you lend me back 100,000 so I can pay the second year worth of premium. No, that's not how it works. This year, January, you give me $100,000. We take the policy, go to the bank gives you $100,000 in January. You need to do something with that $100,000 leverage right away. Invest it. If you're not doing it, then again, we argue why we're doing the leveraging. Invest the money. And by investing it, I don't have access to it in December when I have to pay my next year's premium. I need another 100,000 of cash flow to pay it, and then go back to the bank, get it back so that I can reinvest it in my business. So there has to be cash flow in the business. Don't think of this option as borrowing money to pay premiums, because it's not that either. Okay, so some tax and legal consideration, longevity risk. We talked about that. That loan, if we're doing the IFA, the longer you live, the more interest you pay, the more tax intensive, or the more drain on my net estate you're going to see. Also on the T100, if I live to be 100, it's going to end up costing me more in the long run. David will pay more for the T100 in over 50 years than he would have if he just bought option 2 par. So longevity is always a risk. Loan terms and conditions are a risk. The way you set up that loan could make it very, very risky. So there's a lot of things to take into consideration when setting up loan conditions. Again, if any of you guys are interested in further discussions, reach out to Dennis or myself. We can talk about how we would recommend setting up the loan so that you're limiting any possible risks and unforeseen surprises. The exit strategy, as I said earlier, the best exit strategy is to die. Anything other than that could cost the client money. So we need to make sure the client understands that. There could also be changes in CRA laws about leveraging from life insurance policies and what's tax deductible and what's not tax deductible. So there's always that risk that looms over us. You always want to make sure that the client is getting independent tax and legal advice. We are not there for that. They have to engage their own accountants and their own lawyers. We will, like I said, through our head office team, provide resources that your clients, lawyers, and accountants can speak to get clarification. But we don't provide that clarification as Dennis and I, wholesalers, we don't do that. We need to make sure that we're monitoring the strategy, make sure it's always on good standing. Things can go upside with these types of strategies very quickly. And really the stress test. We got to make sure that we're comfortable with whatever dividend scale we have. This is just a chart that shows historical interest rates for leverage type loans. And as you can see, from about 2000 till about 2020, we were under 4%. And that's why when I say we project out at 5.5%, maybe 6% for the loan if we're doing the IFA illustration, even though currently the lending rate on the last IFA I looked at was about 8.1% because of high interest rate environment. But remember, we're looking at a long period of time of leveraging, and projecting at 8.1 is not reasonable. The plan will never work. It'll never look good, but it's also not going to be 8.1 for the next 40 or 50 years. We know that it is going to come down, and we figure that 5.5 is a good medium. Cumulative cash flows. So this is basically what happens if interest rates increase. So let's say we're not looking at 5.5%, we're looking at 7.5% for the lending rate. Well, obviously, if I'm paying the interest every year, that means I'm paying more money every year. And it's straightforward. There's no rocket science here. Once I get to the $1 million of total loan balance, I'm paying $55,000 a year in interest on the 5.5%. I am getting a tax break on this, but I'm paying $55,000. If the interest rate were to escalate to 7.5 in those years, I'm paying $75,000, which means I'm paying $20,000 more. No surprise here. It's basic math. It is what it is. But we have to understand that interest rate will affect the drain. And even though we project at 5.5, we're not guaranteeing a loan rate at 5.5, and no lender will give you a loan rate that's guaranteed or fixed on these types of scenarios. It's always a prime-based leverage rate. So it's going to be prime plus 1, prime plus 0.5, whatever it is, but it's going to be dependent on whatever prime is. So there will be years along the way where David might only be paying $55,000 in interest. There might be the odd year where he pays $75,000 and then $60,000 and maybe $45,000 because it's a moving target. So we need to understand that interest rate will definitely impact where we're looking. And net estate value, I'm going to bypass this one. It tends to be a little bit of a confusing slide. So some of the takeaways on the T100, it's easy to understand and it's the easiest to present. It's predictable cash flow. It doesn't increase long-term to continue meeting our growing insurance need or our tax need, but it provides me predictable coverage at a predictable price and a very, very simple solution. The IA PAR, it allows me to create a limited payment period, which might be nice and beneficial. The ability of adding that ADO gives me some flexibility in what I have to pay. So I might not have to pay 100,000 every year for the first 10 years. I might run into a situation where I can't afford it and I can drop down to 38,000. So it allows me some flexibility. The cash values or the cash surrender value, CSV, is a liquid asset. So there's an asset that the corporation has that they can borrow against at any time in the future. The downside is it's cash flow intensive. The client needs $100,000 a year versus $20,000 a year, 5 times more cash flow to really make it work the way we designed it. So they have to be prepared for that. And then the last is the leveraging strategy. It covers a life insurance need for sure. It's tax efficient. It reallocates cash flows. So it allows me to buy an IA PAR with term 100 cash flow, but it comes with a lot of risks. There's a lot of things we need to be mindful of. We have to be mindful of what the loan looks like, how it's set up, what the interest rate is, what conditions are we wanting to apply to this loan. There's a lot of things to take into consideration before we can confirm it makes sense for every client. And I'm going to leave it at that. So, why choose IA PAR? I mean, I think I've talked enough about it. We have really, really, really competitive death benefits and long-term cash values. We just increased our dividend to 6%. If you're looking at the wealth version with max ADO, IA has the highest cash surrender values in the first 10 years of any other company in the market. So for an IFA scenario or for a corporation that wants cash surrender values early, it's definitely a great option. We're one of the lowest to sensitivity, the sensitivity test. So if I look at the -1 or -2 on the dividend, which we call the feasibility or the sensitivity test in the illustration, we at IA are probably one of the least sensitive to market shock. So if dividends were to change and not pay what they're supposed to, the impact of a -1 on the dividend for IA is a lower percentage decrease on cash values and death benefit than a -1 with our competitors. It's just the way we've structured our plan. So I'm going to leave it at that and see if there's any questions. And if not, I want to thank everybody for joining us. And I'll stop sharing. And yeah, I'll leave it at that. So thank you guys for joining us. If there are questions, feel free either take yourself off mute, ask the questions, and or connect with Dennis or I, and we can help out wherever way possible. Yeah, I will send a copy of the presentation to you guys. I will stay on for another minute or so.
Thank you.
You're welcome.
Thank you, Kayam.
Thank you very much. All right, I think I will sign off now. So everybody stay safe. And hopefully we'll see you guys all very, very soon. Take care.
Bye, everyone.
Bye. Bye, Dennis.
Bye, Nanette.